Warren tells you the same thing. He's just like, just go buy. But he would tell you it's probably better to buy SPY than Berkshire Hathaway, quite honestly.
Why have you advised your wife to invest in index funds after your death rather than Berkshire Hathaway?
It doesn't make any difference whether the amount she gets doubles or triples or anything of the sort. The important thing is that she never worries about money the rest of her life.
Today, folks, over a 30-year period, less than 1% of individual stock pickers will actually outperform the S&P 500. Obviously, Berkshire Hathaway's Warren Buffett and Charlie Munger have been outliers in this situation, so I thought it'd be fun today to actually look at the 10-year performance on my favorite ETFs, the S&P 500 Index VOO. We're going to look at an income dividend ETF called VYM, and then finally a Canadian broad index fund called VCE. And then what we're going to do is we're going to discuss a very bold statement. Somebody is claiming that in the next 10 years that the S&P 500 will be lower than it is today. Now, if that is a conversation you can appreciate, in return, I simply ask that you hit that like button, folks, because everybody is running around saying that the sky is falling. We are in bear market territory. Every little hint of hope, a little bit of a rally always gets sold off. And year to date, the S&P 500 is down 14%. However, we never want to look at anything in a short period of time. Typically, we want to look at 10, 20-year time periods realistically. And going back to 2012 to look at a 10-year performance on the S&P, if you invested $10,000, guys, today, even with that pullback, you'd still be looking at roughly a $35,000 return. That is pretty astounding, right? And taking a look at the holdings as they sit today and why I love these broad-based index funds is they top weight the best performers, and they do this based off their market cap. So if you have a larger market cap, you get a higher percentage weighting in the entire S&P 500. And honestly, if you take a look at Apple, that has been the top weighted S&P 500 stock, the number one stock on this index for a very long period of time. One of the stocks that I individually held, that thing had like 1,000% return over the last 10 years. So it's really incredible how the S&P 500 index does this through a mathematical way where there's no emotion involved. And if you take a look, Apple right now is still the largest weighted index at 7%. And over time, these top 10 companies, because they've been growing from a market cap perspective so rapidly, right now in this moment, for the first time ever, almost 31% of the top 10 holdings in this index of the 500 largest companies in the US are all these tech companies, roughly, right? Apple, Microsoft, Amazon, Tesla, Google, Nvidia, Berkshire Hathaway, ironically coming in at the top 10, Facebook, and then United Health Group. And then we can kind of get into things like Johnson & Johnson, JP Morgan, Procter & Gamble, Visa, Exxon Mobil, which, by the way, Exxon was like a real small market cap company going into the beginning or the midst of March 2020 during that oil bust, and now they're back into the top weighted, right? And you don't know, some of those guys that are outliers that haven't been performing well, that you don't think are those good as stocks, can always have a comeback. So it's kind of nice how you can still get performance off companies that might be those hidden gems or those things that we think are trash that can still have really great growth and kind of offer some more stability. You got Chevron in here, Home Depot, MasterCard, Bank of America, Pfizer, AbbVie, Broadcom, Costco, Walt Disney, Coca-Cola. These are all stocks I know individual stock pickers will buy when likely they're better off just being in this index, right? So let's move on to VYM. This is my favorite income ETF, and right now it's down about 3.06%. I love this for stability in the market. This stock does not offer the same kind of returns, but for the stability you're getting, considering over the same time year span, your return would have only been 30,000. You're really not giving up too much gains against the S&P 500 while collecting a higher check and again stabilizing a lot of the market volatility, right? So let's look at the holdings in this one as they stand in this moment today, and these will constantly switch out depending on market volatility, right? But at the top of the list, we got Johnson & Johnson, JP Morgan, Procter & Gamble, Exxon Mobil, Chevron, which, by the way, were nowhere near the top weightings literally a year ago, Home Depot, Bank of America, Pfizer, AbbVie, a lot of healthcare companies, Broadcom, Eli Lilly, we got Coca-Cola, Cisco, Pepsi, Verizon, Walmart, Comcast. These are all incredible companies. McDonald's, Intel, all again individual stocks I know people to be buying, building out their own portfolios. Finally, on the Canadian side of the markets, guys, this is one that I'm thinking about buying into using my dividend income from my Canadian stocks. Now, this one's a lot more concentrated because the Canadian markets are way smaller. So the top 10 holdings actually make up about 50%. And just to kind of quickly iterate the dividend income, VYM is currently paying about, right now, I think 2.8% on an income basis. And VOO, I think, is sitting about 1.7, 1.8. And the Canadian index is paying a yield of about 2.5%. Now, taking a look, guys, over the 10-year period, this one doesn't come close and comparable to the performance. You're looking at about a $10,000 investment becoming worth about $24,000. So broadly underperforming the S&P 500 by about 10,000 at a return basis in this current moment. But nonetheless, I really think the Canadian markets are about to blow up. I think they have a much better potential at outperforming the S&P 500 over the next 10 years with our economy growth. The fact that these companies are getting a lot of robust performance, talking about the commodity side, because the Canadian market is largely commodity based and financial based. Taking a look at the holdings here: Royal Bank, Toronto Dominion, Enbridge, Bank of Nova Scotia, Canadian National Railway, Bank of Montreal, Shopify, our only real big tech giant here in Canada, Canadian Pacific Railways, Brookfield Asset Management, and Canadian National Resources. And as you go farther down the list, you'll start seeing more commodity-based companies, things like Barrick Gold, which is like one of the largest gold companies on the planet, which is Canadian-based, a lot of uranium companies, a lot of precious metal companies, everything else in between here. So that's the Canadian markets, and yes, it slightly underperforms, but you get a little bit of a higher yield. And for me, living in Canada, I think it's a good diversification tool. And now let's talk about the QQQ ETF, one that I don't currently hold, but top weights specifically those tech companies here, folks. And this one's down 21%, with about 50% of the holdings being in these top weighted tech companies. We'll look at it in a second. But from a performance basis, I found it interesting that basically from 2012 to about 2017, that the NASDAQ was largely closely following the S&P 500. And only recently in this crazy bull market that we've experienced with that incredible tech rally through the lockdown of March of 2020, guys, that they really started to outpace the S&P and the total rate of return as of this moment, which doesn't look like it's as of this moment because I think the NASDAQ has pulled down more, but you'd be looking at about what, a $58,000 return, give or take $5,000 in the current moment against the S&P's return, which again I don't think is calculating in this recent drop here. But those holdings again, guys, you got Apple, Microsoft, Amazon, Tesla, Alphabet, your Google shares, your Facebook, your Nvidia, Costco, Pepsi. So if you really kind of believe in these tech companies and you think there's a huge future moving forward for them and that they're going to outperform, this is a good way of kind of leveraging up. And then we could talk about like the triple leveraged ETFs that match the S&P 500 and the QQQ ETF, like TQQQ, which by the way, there's another funny ETF that shorts the opposite inverse of QQQ called SQQQ, which I don't play any of those. I think they're a lot more volatile and risky. Over a long period of time, though, they've offered insane returns for those looking for that edge of a little bit more growth and have some volatility risk that my stomach and my cojones can't handle. But I want to show you a quick video of a bold statement I've never heard before. Over the next 10 years that the S&P will be lower than whan where it is today. Take a listen.
Most reliable metrics in history show that the stock market will be lower 10 years from now than it is today. If you think that's crazy, look at every market top in history, every secular bull market top. 2000, the S&P peaked at 1,500 or whatever it was. 10 years later, it was well below 1,500.
Now, personally, I don't feel like this is the dot-com bubble. I don't feel like this is the 2008 financial crisis. And it's important to remember that over a 20-year time period, you would have never lost money investing in the S&P 500 index and over any single time period. Now, it is quite apparent that we are pulling back, seeing a multiples compression on the PE ratio of the S&P 500 because we were heading into bubbly territory during those money printer days, during the crash period there, March of 2020. But now I feel like we're getting into a healthier place. And I have a much harder time believing that over the next 10 years here that the S&P will be lower, because you could have said that the market peaked in 2008 before it dumped, and that's where that 10-year period came in from the dot-com bubble to the next period of the new lows. But honestly, over the last 10 years, going from 2008 till now, we haven't seen us go below those 2008 levels. So I feel like he's kind of cherry picking some of the data here. But nonetheless, guys, in this kind of day and age when we're talking about the technological revolution that Kathy Wood always mentions, I have a hard time believing that these top weighted tech companies will not experience better than expected growth than they've seen in the past. We've never experienced a technological advancement period like we're seeing now across every sector, from fintech with cryptocurrencies and blockchain to the healthcare sector with genomics to obviously getting into the auto industry. For the first time in our lifetimes, we're going through a technological shift that I always state you do not want to miss out on, guys, because it's only going to happen once in your lifetime. You can't go from internal combustion engines to EVs to something else all of a sudden within like one time frame. We're talking about 100-year growth periods here, right? So I think healthcare healthcare is going to blow up. I think all this stuff is going to do fanatically well over the next 10, 20, 30 years. And it's something that I want to be a part of. I really don't think in the next 10 years, the S&P will be lower than where it currently is. Do I think in the next year or two, we could be slightly lower? Absolutely, because the median PE on the market usually sits around 15, but we're living in a period of excessive growth where obviously that growth kind of got investors overhyped and it led the stocks a little higher than they probably should have ran. So seeing this healthy correction, I think, is appropriated, but over the next 10 years, guys, I just can't see how the S&P will be lower than where it is currently today. Now, that's just my personal opinion. Obviously, anything can happen, as that's purely speculation. Nobody knows what tomorrow brings, maybe nuclear war, who the heck knows, but I want to pass that question off to you at this point. I'd love to know what you guys think about all of this in that comment section below. Consider subscribing for future updates and more videos like this, but stay cool, stay awesome, and as always, I look forward to catching you in the next one.